Hi, I'm Steve LaFrance with our slightly delayed quarterly update. As I mentioned on Monday's video, the market performance and macroeconomic summary from the past quarter really doesn't mean much now that we're consumed by the recent tariff announcements. So let's get into what that means, how the markets have been responding, and what investors should do from here. Immediately after being sworn into office on January 20th, Donald Trump either called for or rescinded tariffs on Mexico, Canada, China, and Colombia as leverage to achieve specific policy goals. Soon after, he signed a memorandum setting the stage for, quote, reciprocal tariffs to be announced on April 2nd. Through February, tariffs on all imported steel and aluminum increased to 25%. On March 4th, 25% tariffs were levied on both Canada and Mexico, as well as an additional 10% on China. A day later, a reprieve was granted for the automakers until April 2nd. 2 days after that, another reprieve was granted for goods covered by the USMCA. Mid-March, Ontario announced a 25% electricity surcharge, which was followed with doubling of tariffs on Canadian steel and aluminum, and then both Ontario and the US backed off. Around that same time, the EU and Canada announced retaliatory trade actions, which was followed by a 200% tariff on European alcohol. Late March, a secondary tariff of 25% was applied to all countries purchasing oil or gas from Venezuela, and finally 25% tariffs were announced for imported cars and car parts. This summary does not capture every announced detail, nor every reciprocal response, but should capture the bewildering pace, frequency, and spirit of the initial tariff actions. In short, everything was negotiable, and nothing was permanent, which explains the market's shock when, quote, Liberation Day tariffs were announced after hours on April 2nd, and it was much broader and deeper than anyone anticipated. A universal tariff of 10% applied to all imports, while imports from dozens of other countries will be charged higher reciprocal rates determined by our respective trade deficit, their currency manipulation, and other trading barriers. It's fair to say the markets have not been pleased. Last week was the worst week for stocks since the days of COVID-19. The Dow declined 8%, S&P shed 9%, and the Nasdaq fell into correction territory in 2 days, dropping 10%. Year to date, the Dow has declined 10%, S&P down 14%, and the Nasdaq has lost 19%. Clearly, tech stocks, which have led the markets for the past couple years, experienced the largest pullbacks, and the major indices are now back to early or mid-2024 levels. Many economists and financial analysts aren't thrilled with this either. These tariffs are reaching levels never seen in the past 100 years. The US hasn't had tariffs as high as 20% since the mid-30s. And you have to go back to 1910 to see where it last exceeded 20%. Aggregate tariffs have recently been less than 5% since the mid-70s and in the 2 to 3% range since the early 2000s. Morningstar's reports the average effective tariff rate is now 25.5% and expects the rate to fall by the end of 2025 to 18% and then further in coming years. Ben Carlson shared this chart illustrating how global trade prospered over the past century, except during the span of time between World War I and World War II, when protectionism and tariffs last took root, and this is why economists generally agree that free trade is preferred over tariffs. So tariffs are happening. Market volatility is up. Indices are well off their peaks, perhaps in correction. It's plain English. What does this mean for investors? First, don't panic. No matter the situation, panic and fear never help. This chart helps remind us the previous market pullbacks and subsequent recoveries. The timing is never obvious, but diversification is working very well at this time as bonds remain positive year to date and global stocks outperform. Nothing has fundamentally changed within our economy. Inflation is in the mid-2 to low 3% range. Unemployment is at 4.2%. Experts concede the risk of recession has increased. Not imminent, just increased. And analysts are suggesting both inflation and unemployment may creep into the 5% range if these tariffs persist exactly as they are. Not ideal, but bearable. However, consensus remains that tariff negotiations and adjustments will likely occur. Back pressure from corporate CEOs and various politicians is also building against the execution of this strategy. What happens next is unpredictable, which can be unsettling, but it's hard to imagine this remains intact for an extended period of time if economic and market pain become too much. As investors, we always knew there would be bumps along the way, and this is clearly one of them. Just as quickly as everything appeared to go sideways with these tariffs, they can be undone. with the next announcement or negotiation. Meanwhile, investors can benefit from rebalancing, diversification, and reviewing how their risk is in harmony with their long-term objectives. We recommend sticking with this disciplined approach. Well, that's all for now. Stay your course, take care of yourselves, and thank you for your trust and confidence.